Good morning, ladies and gentlemen, and traders around the globe. We from Admiral Markets say welcome to our real-time daily trading idea webinar. In this webinar, we have 5 days with 5 different traders. And each trader has a different trading style. We would like to screen the markets here today, show you some interesting trading setups, and for sure answering here your questions. But please be aware of the risks. So here's our risk disclaimer. So Forex and CFDs are complex instruments, and it's trading with leverage. So please be aware of the risks here. And all we are showing and presenting here is just a personal opinion of our traders and not an advice for investing. So here you have a picture from me. My name is Tim Temp. I'm account manager from Berlin here in Germany. And we have the pleasure here today with Jay Medrow. He is one of the famous Forex and CFDs traders here in the German area, and not only in the German area, so more international with this webinar here for sure. So here we have a quick overview of some of our offerings. For example, here our bestseller, the DAX 30, with a typical fixed spread of only 0.8 point during the main trading hours. These are other products you can trade without any commission, and for sure, if you have any questions or something, so please contact our customer service. For example, how for our global offers. Because we are an international brokers and we have different licenses all over the world. So feel free if you have any questions here. But it's it from my side. So I have the pleasure here with Jay. Good morning, Jay. Hope you're doing well and your PC is running. You have the stage, and you can start, my friend.
Good morning, Tim. Good morning, traders. Pleasure to be here. Ah, God damn it. Oh, I was just cursing. Sorry. I don't know which screen it's showing. This one I wanted to show. Now, where can I see what you guys are seeing?
That looks great.
All right, look,
this is the right slide.
All right, that's the most important thing. Good morning, traders. Good morning to my traders. Good morning, Tim. Good morning, FX world. Let's get right into it. I hope you had a decent week last week. We had some super surprises. What was our trade from last week, Feb 25th? We were looking to long the Aussie dollar. First trade was to look for a long right around the 71.5s. That's what I call it. And then a later trade would have been to potentially look for a long around the 71 evens. But if a trade target has been reached, in this case, 72 area, then that's it. That negates the second trade. All right. I'm telling you this because this is the outcome. The first trade got within 2 pips of the target. So depending on which broker you're using, add the bid offer spread. You are right there. Do not do me a favor. Let a winner trade turn into a losing trade. That's just useless. The market did exactly what we expected. There was a reaccumulation at the role reversal. We hit into the target area. Then it stalled on higher volume, turned around. So that's it. Trade over, did what we wanted to. And from then on out, Aussie numbers came in weaker than expected. So we had the sell-off. We had some superb dollar numbers. I read some research this morning, which was so low quality. Of course, it came in lower overall. The development of the US dollar GDP numbers are lower GDP developments, but it came in at, for the fourth quarter, 2.6%. Priced in was 2.4%. And if you look at the US yields, from that data point on, all we've seen is a bear steepener. So the yields are going through the roof. Short end is pretty much anchored. The market does not believe that Jay Powell and his Fed will do anything in the short end. So that's just nailed down to unchanged for the rest of this year. So all the action is currently happening in the inflation expectations bucket, the 30-year as well as the 10-year yield. All right, maybe a little bit advanced about my traders, and I have a lot of my traders in here actually know what we're talking about. So trade 1 winner, trade 2 never happened because the target was already reached. Hopefully that makes sense. Headlines this morning: Asian equities were higher across the board amid trade optimism. Mainland China outperformed with their blue chips called CSI 300 above 3,000. Shanghai also above, Shanghai was above 3,000. US-China trade deal is at its final stages. Supposedly, China said foreign investment laws will strengthen IP protection. To be seen, to be see. In Forex markets, we saw the Dixie, that's the dollar index, the dollar versus 6 major other currencies, or roughly 57% weighted against the euro. So the euro US dollar inverted is the DXY. Very high correlation. It's not is the DXY, it's a high correlation to the Dixie. DXY is called Dixie. It opened weaker because my friend, the President of the United States of America, Donald Orange Hair Trump, said the dollar is too strong. And just like we saw last week with oil, there's a short-term reaction. If you're an intraday trader and you don't have Twitter on your mobile and the mobile presented in front of you, you're missing opportunities. For whatever unbeknownst reason to me, the market reacts to his tweets and has done so for a year and a half. And we've been making money for a year, maybe almost 2 years now. Complete nonsense. There's nothing he can do about the dollar. Zippo, nada. But the market reacts initially on his tweets. All right, so the dollar is too strong. Aussie balanced trade talks and data. That was important overnight. We had Aussie data. It's coming in mixed. And another note, in the past, we have a lot of guys like Larry Williams, for example, trading the Commitment of Traders report. And I recall that a while ago, there was a very strong Commitment of Traders report for long Aussie dollar. And then for many, many months, we said, you can't forget about the signal because there's a trade war going on with China and the US. As long as this trade war is going on, the Aussie dollar can't really rally. Well, now the trade war might be coming to an end. And by the way, 95% of this scenario is priced into the market. So it's really coming to an end. We could actually see a buy the rumor, sell the fact reaction, i.e. risk assets coming off. Okay, they might be coming off because it's already all priced in that this war is over. Anything else happens, the markets are going to come off in disappointment. You'll see that. Okay, anywho, where was I? Aussie dollar, right. So now that the trade war is off, one could think, okay, the Aussie dollar could rally. Well, in the meantime, a lot of things have changed. Global growth has come off. So there is no Aussie dollar strength at the moment. In fact, Westpac is thinking and talking about 2 rate cuts coming up until the end of 2020 for the RBA and the Aussie dollar. So to go based on statistics, seasonality, shit that worked in the past has nothing to do with the current environment. Nothing. It's completely nothing. You have to put everything into the current market context. If you're able to understand what's currently going on, and if you can anticipate what the big boys are going to do, and I'm not only talking about banks. The banks are okay, it's one player. Mostly they're market makers. No, it's really the funds. What are the funds doing? So what we saw last week was, for example, the GDP numbers in the States came better. Well, nobody had that on the radar because the consensus positioning was for 2.4% growth. In came 2.6. I know that it's old data, and I know that it's stale. And I know for Q1 we'll get a data number print around 1%, a little bit above, a little bit below. We'll see that, yeah? But currently, at that point in time, the big funds were not positioned long enough in the US dollar and in the rates market. And that's why we actually saw a sell-off in the treasuries. All right, back to what's going on. Q1 was firmer as well. Magic number for the dollar renminbi is 7.00. This is a quick update of the macro scenario where we are. So this is a weekly basis, where are equities in the US right now? Well, we had the worst December of all Decembers ever tracked in the history of mankind's markets. And now we had the sharpest of all short covering rallies ever. It's a short squeeze. Fundamental data is continuing to deteriorate. I call it with my traders, we're in the middle of the middle of the middle of the middle. There's nothing really to do right now. Now, did I participate in this long? No, I did not. Does that make me a bad trader? No, it doesn't. The fundamentals were shit, so I'm not participating in this. Now you can say, yeah, he's such a bad. No, I'm not. It's my money. It's my money. I'm not putting it into a market where we have earnings expectations at 0 and the market trading at 18 times multiple. That's bullshit to me. That's not value. I'm not buying that. And that doesn't mean that I'm a value buyer. Anybody who's a momentum investor or trader, it's more like a trader, a momentum trader, and who's long, congratulations, awesome, you did everything right. But what are you going to do next? Because as you can see, the US Treasury market is coming off and the curve has started to slightly bear steepen. Now that's interesting. That's an asset rotation. That means some of the money is actually going out of treasuries and into the equity markets. Why is it doing that? In my personal opinion, that's funds. And that's funds that are experiencing fear of missing out. But that's just one piece of the puzzle. Not every single fund on earth is getting out of treasuries and into equities. That's not at all the case. I'm just saying this is part of some of the explanation, you know? So the question is, where does the money go? We know at current quantum currency swaps, it's beneficial to Japanese traders to go back into their home market. So they're selling treasuries and they're going back into Japanese 10-year and 30-year. And by the way, this year we have new 10-year and 30-year issuance in Japan. Then we know that some of the European funds are staying back home. So they're not investing in treasuries. So it's super interesting, to me at least, to see this. Then commodities. Shouldn't be commodities higher if the dollar is coming off? Commodities are range bound. That's the black line. And then the yellow line is what we call the break evens, the treasury break evens. So that's that's a gauge to us in terms of inflation. There is not much inflation expectation, or there's not much expectation for rising inflation in the market right now. So how far can the steepener go if there is no inflation materializing? So it's all coming back to correct fundamentals. Picture overnight, strength versus weakness. We had some pound strength. Morgan Stanley this morning said, okay, close your eyes, buy the pound. Pretty much that's what they said, versus US dollar. Now, why versus the US dollar is beyond me, but they'll have their reasoning. I would go for a much weaker currency than the US dollar, but all right, fine. Morgan Stanley says buy the pound. Their target is 134. If you've watched this morning meeting for a while, you may recall that the 134 was on our radar from a while ago already. We had investment banks tell us 134 is the target. And congrats out to my ex-colleague Kit Chooks over at Nomura, who said this way beyond, way a long time ago. He said 134 and to the downside 124 in case of a Brexit. So 124 downside target, 134 upside target. All right, euro US dollar, euro US dollar. So we saw this pound and dollar strength overnight. Here's a reaction to the Aussie numbers early in the Asian session. So there was risk on, and then it was priced out again as additional numbers came in. Let's have a quick look if I can find it. Let's have a quick look at these numbers, talking about them. So we had building approvals coming in better than expected, and that is something that the RBA is keenly looking at. That's why we had a positive reaction in the currency. But then we have company operating profits coming in much worse. So we had an up-down reaction, which is not uncommon. Construction PMI in the UK came in bad, came in worse. Now, is the market reacting to that, yes or no? Well, not really, because, well, a little bit, sorry, a little bit. This is what's currently happening in the last 60 minutes. So we can see we have a little bit of Japanese yen strength, a little bit of Swiss franc strength, and then we have pound weakness based on that number that came in much worse than expected. Actually, in below 50 means in contraction territory. We have a rate statement out of Australia later on. I prepared a slide on that. We have services PMI out of the UK. That's going to be important. Chinese speaking, always important. Once Brexit is out of the picture, the Bank of England stated already that they're rather leaning towards hawkish next steps, all right, and not dovish. We have Canadian numbers coming out with the rate statement. That's going to be super important. Have the trade balance and Chinese numbers. China, I have a whole slide for us because there's something important happening over the next 10 years in China. We have the ECB on Thursday, including a press conference. We call it a presser. And then we have Canada employment data on Friday, and we have US employment data on Friday, and then some housing data. And then Saturday night, we have inflation data over in China, okay? So it's going to be a super good trading week, super. What do we have over in China happening? I alluded to it early on. We have the National People's Congress starting their 10-day super event. March 5, roughly 10 days. March 6, i.e. tomorrow, we'll have the fiscal budget report, and that's outlining all macroeconomic policies and reform objectives for 2019. And then we have several data points. There's several press conferences happening, but we don't have the times yet. One time we do have, and that's March 15 press conference held by Premier Li. Good. Focus will be obviously on their growth target for their GDP. It's centrally planned. It's not like the rest of the world, you know. This is centrally planned, and the expectation is that they're going to set it around 6 to 6.5%. Versus in 2018 they said around 6.5%. And supposedly it came in at 6.6. I'm being sarcastic because nobody knows what the truth is or isn't. Okay, CPI target is expected to be held unchanged at 3%. Actual, supposedly it came in at 2.1% in 18. In terms of wording, steady growth is forecast. Steady growth forecast is expected to be maintained for the M2 growth. That's a measurement of money in the system, M2. You can Google it. And for total social financing growth, in short, abbreviated TSF. What's TSF? It's basically a broad measure of all credit and liquidity in their economy. All right, so steady growth is forecast. Now recall, in 2008, they saved the global ass by punching out the largest credit bubble ever. Okay, they helped everybody by pumping out credit like there's no tomorrow. They're not doing that right now. So yes, there is a coming off in terms of global economic growth, but China is not doing the same thing. China is focusing on helping their domestic demand and on actually containing their shadow banking system and the leverage in that system. Their fiscal deficit is forecast at 3% of GDP versus 2.6 in 18. So there you can see that they're willing to spend 40 basis points additionally of GDP to help their domestic demand side by pumping out credit. The jobless rate target is expected to be maintained at beneath 5.5, and urban job creation expected to target at least 11 million. More reforms of the financial sector and opening up measures are expected, and that would sustain China's long-term growth. That's the whole deal. Stabilize domestic demand, be not any longer the workbench of the world at cheap labor. Those days are over. And opening up your gigantic market to outside firms, international companies, in order to secure your own long-term growth. That's the game being played over there. What do we have else going on? Euro, ECB, Thursday. Main refinancing rate obviously expected to remain unchanged at flat. And then we have a presser. The asset purchasing program, the net asset purchases of that APP ended in December of 18. Please recall that. So that is less accommodative. It's a bit restrictive. Same scenario as in, well, similar scenario as when the Fed stopped it. Stopped purchasing debt in the past. But the ECB currently reinvests all principal payments from maturing securities, and they did not give an end date. So everything that is redeemed is being reinvested. Surf over to their website. You can get the redemption calendar, and you'll actually see these are the dates that where some stimulus is coming into the market. So a bit like, in an exaggerated terminology, euro weakness and then potentially DAX strength. Recall, they stated that the risks to the growth outlook have now moved to the downside. Away from prior statement, or the statement prior to the last one was tilted to the downside. Now they have moved to the downside. The ECB is widely expected to cut its inflation and growth expectations in March and or latest in June. And then UBS, for example, expects 2019 growth to be lowered to 1.3 from 1.7%, 2020 lower to 1.6 from 1.7, and 21 unchanged at 1.5. Question to you guys, is this euro bullish or euro bearish? Very good. These are just my traders. The new guys are not, or the other guys are not saying anything. Oh, Darshan, thank you very much. Excellent. You're new to me. Welcome. Thanks for coming in. Exactly, guys. That's bearish. So what are the current ranges. What's the top side of the euro US dollar? What is the bottom side of the euro US dollar? Stancio, thank you. Thanks for coming in, mate. What's top side? What's the bottom side? Give me the brackets of the euro USD. I just want to see if you switched on. 114.90, I like it, Stancio. I would go as high as 115, but I'm with you. Correct. There's a huge barrier at 115. Thanks, Andrea, for sending that in this morning. What about to the bottom side? Ooh, Bodo, 112. Oh, yeah, okay. Yeah. I would see, exactly, Jochen. I would see 115 and 113. Excellent. Okay, thank you very much. Just wanted to check that real quick. So, guys, not much for you to do until the market hits that decision point, either to the up or to the downside. Okay? Not much to do until you get to a decision point. Maybe that helps your trading. UBS expects inflation to be cut to 1.4 from 1.6, 2020 to 1.6 from 1.7, and 21 unchanged at 1.8. What's oil doing right now? Right now, rising or falling? I know we hit 57. What's it doing? Is it above 57 or below? What about my guys? Below. Thanks, Michael. Exactly. Oil is a pretty decent gauge for you in terms of inflation and inflation expectations. So if oil is coming off again, these numbers could actually get revised lower and lower. If oil rises, then that might be it in terms of revisions, and we would get potentially an updraft in inflation expectations. Okay, the focus will be for the ECB if they would need to offer another targeted longer-term refinancing operations program. In short, TLTRO. My traders are all over that. If you're new to it, Google it. That basically means that the ECB gave super cheap financing to financial institutions, i.e. banks, for a period of up to 4 years. The more credit you were pumping out as a bank, the cheaper you got the money from the ECB. In fact, the second program was so ridiculous that you were getting paid. You were getting paid as a bank to take this money from the ECB and then basically give credit out to businesses and retail clients on the back of it. Why is this so important? Because Italy is in its third recession currently in the last 10 years. So Italy in recession and Italian banks' loan books looking like shit, excuse my French, means, of course, in my current expectation, there will be another TLTRO. Highly likely, highly likely. And is that euro bullish or bearish if it comes? Bearish, exactly. All right. It's difficult for me to see a long-time bull in the euro right now, but I'm not sitting here and stating that it can't go higher. In fact, it needs to go higher if all the big boys and fund managers agree that it's a short. It first needs to go higher, so there will be an active manipulation higher. Markets are currently pricing in only a roughly 50% probability of a 10 basis point deposit rate hike this year. I, at the moment, don't see it at all in 2019. I know that we're still talking about rates will remain low through the summer of 2019, which the market then implies a 50% probability for a 10 basis point rate hike after the summer of 19. Currently don't see that. But of course, I can't argue with the market, and neither can you guys. It's a 50-50 toss. We'll just have to see in terms of GDP growth, how it's coming in, and inflation numbers, how those are developing, i.e. keep an eye on a hold. Roger? Roger that. All right. Dollar and the Fed. Friday we have NFP. Yoo-hoo! 185K versus 304. Now, I haven't talked to you guys about this in the past, so I'll mention it now. It's important. Usually the big boys look at as what's called a 6-month average payroll addition and a 12-month average. So a single headline print looking super sexy or super bad can, of course, cause a reaction in the dollar. But it's more relevant to look at these averages because it takes some of the noise and seasonality out of the headline number. And the unemployment rate is actually expected to tick down to 3.9 from currently 4. So some of last month's jobless rate may get priced out. Recall we had this government shutdown, and some banks are estimating that actually added 0.05 percentage points to the last unemployment rate number. And that is partially the reason why we're expecting a lower number, because that shutdown has now ended. Bank of America Merrill Lynch, it's probably the last time that I can say that because they're dropping the Merrill Lynch name, very sad, sees wage growth ticking up by 30 basis points month on month. And that's actually the consensus. So they're saying, if our forecast proves correct, then the yield year by year should move up to 3.4 from 3.2, consensus is 3.3. So I often get asked, what's more relevant, the month by month or the year by year? And you know, it's quite funny because there's no standing rule to it. Sometimes the market reacts more to the monthly figure, sometimes the market reacts more to the annual figure. I tend to focus on the monthly figure first. That's me though, okay? Have a look at it, gauge the reaction of a market to its figures, and then you'll get your own feel, and most importantly, you'll start building relevant experiences. So that would mark the strongest wage gain seen in the current business cycle, 10 years of expansion, by the way, and supports their outlook for wage growth to gradually track higher this year. If wage growth tracks higher, is that bullish or bearish for the US dollar? If wage growth tracks higher, is that bullish or bearish for the US? Exactly, Michael, it's bullish. Because then the train of thought goes potentially the Fed needs to start hiking one more time in 2019. Roger that. Canadian dollar, Bank of Canada. Friday we have employment change expected at a loss of 5,000 employment versus a gain of 66.8 thousand last time around. The employment rate is expected to come in at 5.7. Sorry that I wrote unchanged. I double-checked the number on Reuters. It's 5.7. I know all of the free calendars out there on the internet state that it's still 5.8. Some of my traders and myself, we have Reuters, and we obviously get the cleanest data real time. Wednesday, we have the Bank of Canada rate statement and the overnight rate expected unchanged at 175 with no press conference. So, okay, fine. What does that help us? Well, please recall that the GDP print last week was horrible. It came in at minus 0.1%. So what did we talk about the GDP growth of the US? That came in much, much better. And Canada came in worse. Also, inflation data last week came also in worse than expected. So naturally, US dollar, Canadian dollar, long or short? I will, Darshan. Exactly, Michael. Okay, Darshan asked me to flick back real quick, and we will accommodate his wishes. Is it his? Hopefully, yeah. Here you go, sir. That number. Gradually looking for wage growth to track higher. You got it? You got it, Darshan? Of course, mate. One team, one dream. We're all traders. We're just trying to make a living here together. I'm just trying to help you guys, stopping this technical bullshit and focusing on what us bank guys are looking at. All right, where were we? Okay, focus. The Bank of Canada is focusing on the housing market and private consumption. Why? Because they raised rates. And now the consumer needs to get used to his or her future mortgage being more expensive and disposable income being less due to higher rates. So that's what we're looking at. Is private consumption actually deteriorating, or is it holding up well? And what does the housing market do? RBC expects GDP growth to pick up after the first quarter of 19. And then, and I thought this was interesting. I mean, this is this is RBC. This is not like Commerzbank in Frankfurt. This is RBC in Canada. And they're stating they expect a 25 basis point hike in each of the quarter, in the third quarter and in the fourth quarter of this year. So if that is the case, is the Canadian dollar long or short? Long, exactly, Emma. Very good. That's actually a long. So we can't really fall in love with the Canadian dollar short. It could be a trade based on oil weakness and shitty GDP numbers, but it can't be a long-term investment. Okay, and then we'll have, as always, the Deputy Governor delivering the usual economic progress report that follows a non-monetary policy report meeting the following day. And that is what this meeting is about. It's one of the non-monetary policy reports, and that's why Patterson will talk to us the day after. And I'm excited and interested to hear what he says, and I'll be in front of the screens ready to trade dollar cat. All right, Aussie. 2 slides on Aussie. I hope you guys are still focusing. Grab a cup of coffee. Let's go. Let's work. This is our work. This is how we make money for the rest of the week. Let's stay focused. Tuesday, we have RBA rate statement and the cash rate is expected to come in at unchanged 1.5. And the market now expects, attention, 1 rate cut by the end of 2020. Previous meeting was less dovish than expected, as the RBA stood firm with its rhetoric of no strong case for near-term move in rates as housing prices came off. So obviously we need to keep housing prices in Canada on our radars. And then we had Governor Lowe coming out the next day and he said, guys, maybe the market misunderstood us because actually what I'm trying to say is this. And he said rates could move in either direction. And that was a first, depending on inflation, which is currently below the target of 2 to 3%, coming in at 1.8. I put a picture of it right in here for you guys. Aha! So the Aussie came off hard at the time. Then we had the minutes. So the analysts at the banks and funds actually combed through the minutes. And the minutes stated that should house prices fall much further, so you need to look at house prices because the bank is already telling you what they're going to do. The RBA states if house prices fall much further, then we expect lower GDP growth, then we expect higher unemployment, then we expect lower inflation. And Westpac is ahead of the RBA, which is not difficult because central banks around the Western world tend to be months behind the curve. And Westpac has probably a switched on model and they expect a 25 basis point rate cut in August, followed by another one in November. Is the Aussie a long given the scenario? No, exactly. Could be a short, Jochen. Could be a short. Contra to the short is all these guys thinking, wow, the trade war is over or coming to a halt, and then, you know, China is going to rally, and well, Chinese equities are rallying because the MSCI last week said that they're going to increase the weighting of the Chinese equity bid in their emerging market MSCI index. And that causes a measly $70 billion equivalent of additional passive funds going into Chinese equities. And that was the sole reason why last week, in addition, obviously, to the GDP print in the States, equity markets across the globe rallied. It was based on this index change. If you know the reason why something's moving, then you can stop panicking about it, and you can either front run it, because 70 billion into the market is going to take a few days. It's not happening in one click. By far, it's not happening in one click. And then you know why equities are rising, and you can be a little bit calmer about it, okay? All right, so Aussie dollar, not really a long given the current scenario. We then saw dismal housing, finance, and construction figures for December. They were really dismal. Negative 6.1 versus expected 2.9, and negative 3.1 versus expected whatever, 0.4 respectively. So credit growth equals GDP expansion. We need to see credit growth. Otherwise, a Western economy doesn't grow. It's not only a Western economy, obviously the same game is being played in China. So for Aussie, we are keeping a keen eye on the housing data, all right? Keen eye on the housing data, please. And on the labor market. The labor market starts deteriorating in any sense, shape, or form, then we know that the market is starting to increase the probability for a rate hike, for a rate cut in by the RBA, and that would lead to Aussie dollar weakness. It is so friggin' simple, this job. It is so simple when you know what to look at. It is so simple. Wednesday, GDP, not 4 versus not 3, and GDP on a year-by-year basis, 2.6 versus 2.8. Again, the same scenario. What is more relevant, quarter by quarter or the annual number? I tend to first look at quarter by quarter or month by month, and then the annual development. And then I gauge the reaction by the market. The market tells me how it interprets the numbers. So I listen to the market. Westpac notes that the Aussie economy lost momentum in the second half of the year. So we were running at 4% in the H1 18, and then we came off to 1% in H2. That is horrible. That is one of the reasons why the Aussie dollar came off. And Andrea, thank you. She posted a picture to our traders last weekend in our chat about Japanese GDP growth, which came in shitty for the fourth quarter. And that is part of the answer why the Japanese yen is so weak, regardless of risk on or risk off. It's just weak. The risk on, risk off currency last week was the Swiss franc. And we know that Jordan, the head of the SMB, does not allow the Swiss franc to appreciate to no end because he actively intervenes with his guys at all times. They do not allow the Swiss franc to appreciate to no end. All right, so we had the slowdown in the economy in the second half of 18 over in Australia, and the lending conditions tightened. They tightened because the 4 largest banks in Australia actually increased the lending rates. So the RBA didn't have to move. The banks did it for the RBA, and then wage growth also failed to bounce. Big problem. Westpac sees growth coming in at 20 basis point Q&Q and 2.4 annually. The bank points out there was weakness in December on the back of unfavorable weather conditions and hampered construction activity, while exports likely stalled. And we did see various economies last week where export numbers came in worse than expected. Yeah, we did have one export component being responsible for the fourth quarter GDP number in the States coming in better than expected. But that is a fickle component, very difficult to forecast, and the expectation is for it to be actually revised lower. So I fully, at this point in time, today, what is today, March 4th or whatever, I expect Q1 numbers, GDP growth in the US to come in horrible, with a revision lower of the 2.6 that we saw last quarter. That's why I'm not a super strong dollar bull at the moment. Nevertheless, given that we did have this number and that funds, what number am I talking about? I'm talking about the fourth quarter GDP growth number in the US coming in at 2.6. Expectation was 2.4. We did see some adjustments in terms of order flow for a long dollar. There's still a rate differential, so a possible trade opportunity for me is long the US dollar and short the Canadian dollar, especially towards the latter half of the week. I'm expecting weaker economic numbers out of Canada. Like I said, Q4 better than expected, good econ numbers expected for this week in the US. Canada, weaker expected GDP numbers than expected GDP numbers last week. Potentially a weakening oil price weighing on the Canadian dollar and worsening econ numbers towards the latter half of the week. That gives us a potential trade opportunity in trend direction, which I want you to do in the beginning. I want you to just follow an economic trend. Risk to the trade, Trump tweets. Again, there are great intraday opportunities, but don't get married to whatever the market's reaction is to any one of his tweets, because the guy has no power, none whatsoever, in terms of adjusting rates. That does the Fed. That's the Fed's job. Jay Powell is in charge there, and or the US dollar, all right? That's basically determined by yields. And since the Fed controls the short end of the yield curve and nothing's happening there at the moment, and inflation expectations control the long end of the yield curve, Trump has zero influence of what the dollar is going to do next. None. Zippo. So the tweets are great opportunities to fade the reaction. Obviously, the reaction was what? Did the dollar rise or fall after the tweet? Exactly, Michael. It fell. Great opportunity to fade that initial move because it's not sustainable. Economic numbers coming in differently and oil prices strengthening. So, last slide. What's happening? This basically is an economic event. Then we had a top right-hand hold, and then we have an extension higher. And now we have another top right-hand hold. I'm expecting market makers to manipulate lower to get into the trade. So if we're conservative, we're looking for an entry around 132. I'm sure you all have your own entry signals. That's great. And then look for the 133 level to be tested again, and a stop loss roughly 50 pips below, giving us a decent risk-reward ratio of 1.89. All right? That should make sense. It's an easy conservative trend in trend direction. Fundamentally, sentiment, everything is in line. Cool? All right. How much time did we spend this morning? I don't know. I don't see the I think we're
Time
good.
is relative, so you gave so much input, so it's very nice. And
It was a little bit longer today. Sorry, Tim. I had
no,
lots
no
of
problem.
a lot of stuff. Sorry, man. I put a lot of work into this for you guys because
For,
I'm really trying to help.
for sure, and we learn a lot. So me as well, and all our listeners, we give great feedback here to you. So I think all is fine.
Excellent. Thank you. And thanks to the new guys coming in. And thank you very much to my traders always coming in, showing up here on a Monday morning. I appreciate all of you greatly. And I appreciate you, Tim, for hosting us. And thanks for the opportunity. I wish you a safe week. Great statement I heard over the weekend by the founder of TopStep. He said, always trade for tomorrow. And I like that. I want to pass this on to you guys this week. Do not let any single one trade ruin your week or your account or blow your account. 80 to 90% of retail traders blow their account within the first 90 days. Do not be one of them. If you pass 90 days and you're still alive, congratulations. I'm proud of you. We are proud of you, right, Tim? I pass it on to you. Thanks, and I'll see you all next week, hopefully.
Yeah, Jay, we will see and hear us. So yeah, you are always welcome. Thanks for all our traders and clients who join us here today, and who give a great feedback here. And so I wish you all a good week for sure as well, and nice trades. We are back tomorrow at the same time. We are with our real-time daily trading ideas, and for sure, Jay, you are back next week. So that's my part here. And so thanks again. Have a great day, and we see us. Bye bye.
Bye bye.